Welcome back, my name is Arya and I don't waste your time, so let's get straight into it. Ladies and gentlemen, in today's video, pretty straightforward, we're going to be doing a portfolio update. Just one thing I want to get in at the start of this video, I actually post a very thorough portfolio update and my thoughts exactly on like all the different holdings, what I'm thinking of buying, what I've sold, all that type of stuff. It's always going to be pinned at the top of my page over on Twitter. And so if you want more frequent updates on what I'm doing with my personal portfolio completely for free, it's always going to be pinned at the top of the Twitter page. Now, with that in mind, just to give you a frame of reference, this is what the portfolio looked like the last time I updated you over on Twitter. As you can see, I still had a couple different holdings which no longer exist in the portfolio. Namely, it is going to be MSCI and EVVTY, which is Evolution Gaming. And I've, again, over on Twitter and in this video that I updated you guys on last time, I went pretty in depth on why I'm selling these two businesses. With Evolution Gaming, it was a brokerage issue. I transferred my brokerage from this one bank to now over to Interactive Brokers. And in the process of doing that, you can't actually move ADRs. And then in terms of MSCI, the reason why I sold that one was I was just kind of looking at it. Most of the growth from that business is coming from the ESG segment of things. And ultimately, I was unsure of how long and for how much more the growth of that side of the business could continue on. And so I sold it, and I've since started a Mastercard position from the funds of both the MSCI, the Evolution sale, and a little bit of cash that came in from my job. So the combined position for Mastercard has since grown to 10%. Now, other than those two sales, you might notice there's a couple other things that have changed here. In particular, Paycom went from roughly a 6%, closer to 7% holding, all the way down to a 2% holding. I did this yesterday, actually. And again, over on Twitter, I've done a pretty thorough explanation of why that is, but I'll give you the gist of it here as well. In essence, I was kind of looking at Paycom and adjusted for the stock-based comp issue that they recently had, which I'll show you here. Essentially, in this quarter, Q1 of 2024, what had happened is the co-CEO gave up his role at the company, and because of that, the new CEO kind of gave up his stock options and whatnot, or some version of that story. And in essence, him giving up the stock options on a GAAP accounting basis, that counts as a negative stock-based compensation event. And so because of that, when you're looking at the PE estimates, everything's been thrown off. So on a trailing basis, you're a little bit misled to believe that, oh, this is like a 20 PE company, whatever the case is. In reality, if you adjust for this negative stock-based compensation, you're looking at roughly $6 of earnings per share. Today, you're looking at $160 stock. That lands you at like a 27 PE on a trailing basis. So again, a little bit misleading that it's a 20 PE on GAAP basis. This is partly the reason why I personally don't really like to look at the PE ratio, although I'll admit I've been kind of using it as a frame of reference more recently. But again, this is one of the reasons why I don't like using the PE ratio. It can be manipulated very easily with stuff like this, right? So again, it's Paycom. It's roughly like a 27 PE if you adjust that out. And then you're looking at Google over here, which Google, in my personal opinion, I've said this many times before, in my opinion, it is the best product ever created on earth ever, and they so happen to sit on a mountain of cash flow, and they benefit from one of the biggest massive secular tailwinds in existence ever, the transition to a digital world, right? And it's just a truly remarkable, amazing business. So I've been very vocal of the fact that I just absolutely love Google, and Google traded at a very cheap valuation. So you have Paycom over here, which is a very narrow moat software vendor, and they're seeing a de-acceleration in growth. And then on the other hand, you have Google, which is seeing a re-acceleration in growth. On top of that, they have a incredibly wide moat, and they're trading at like a 22, 23 trailing PE, right? So it's a cheaper company growing faster with an infinitely better moat. Now, of course, in the extremely long term, and I spoke to Dividend Dude, which many of you guys probably follow him, but Dividend Dude, one of my YouTuber friends, I spoke to him, and he's also a big proponent of Paycom, and he was saying, oh, you know what, but if you span out in the 10-year time frame, maybe Paycom has a higher total return if, they smash it at the park, this and that, and they have more potential. I'm not denying that, absolutely. But I just find the execution of that something that I wouldn't personally want to bet my investment dollars on. I think Google at today's prices, which I bought at like 160 per share, I think that's a much better holding for me personally, makes me sleep at night much better and whatnot. Another change you might have noticed, we have a new holding in the portfolio. That is, of course, Uber. And I did a hour-long stock analysis on Uber. I went through thesis with that company, why I think it's poised for just massive operational leverage. And that is a business that is benefiting from not only having more people try the ride-hailing app and the groceries, the food delivery, all that type of stuff, and just basically every geography in the world other than like 5 countries, give or take. They're benefiting from that shift of people switching over to Uber instead of doing taxis, instead of doing traditional delivery and all that type of stuff. And then on top of that, half of the users on the Uber app typically only use Uber for either the delivery or the rides once or twice per month. So we have this core group that only use Uber once or twice a month. And I think in the future, if Uber could even double that and they would go to 4, and all those people, that cohort of people that only use Uber once or twice a month, if that cohort of people start using the Uber app more and more, that should translate to growth for many, many years to come. And so that's kind of the thesis with that over there. And anecdotally speaking, me personally, I tried Uber Eats for the first time actually just shy of 4 years ago, right? And I went from using Uber Eats every couple of months, occasionally using it for special occasions, you got like a party going on and last minute thing, you want to order something, all that type of stuff, to pretty regularly being a Uber Eats user. I'm over at a friend's house, not really trying to leave the function, all that type of stuff. Oh, I'm gonna Uber Eats. You guys want something? Yeah, let's just get something from McDonald's, this and that. All of a sudden you got a group order, 30, 40 bucks, right? So me personally, anecdotally speaking, on top of that, I've noticed that over time I've become a more avid user of Uber products and services and all that type of stuff. And I guess maybe another thing I want to fit into the end here, I don't want to keep rambling about Uber, this is an Uber video, but the grocery category and the retail category, that's something they consistently talk about in the earnings call and that type of stuff. Currently, only 15% of Uber users have tried those categories. So I think in the future, we'll see this broadening of, initially you had the ride hailing service and then you got the delivery, and then now we got all these various different services that they're trying to tack on and kind of cross-sell you on. So I think there's a lot of opportunity there. And again, before you say like, oh, I would never order groceries off of Uber, think about like 4 or 5 years ago, right? Like you probably didn't try the delivery that Uber offered. You knew it existed, but you hadn't tried it out. And then of course the pandemic kind of threw that into hyper growth, and all of a sudden everybody tries that out, right? So again, like there's a lot of opportunity. I'm very optimistic in the amount of growth that business can drive. I think there's a lot of free cash flow growth. Check out the video for a very in-depth look into the Uber thesis. Again, it's about an hour long. The top 2 holdings in the portfolio remain the same. It is still Amazon and Salesforce. I have never sold a share of either of those businesses. I don't plan to sell a share of either of those businesses. Quick shout out, the Salesforce video I did was the most comprehensive, the most thorough analysis of Salesforce anywhere on the internet. I can guarantee it. Link to that in the description. It'll also be in the corner as well if you're interested to watch that. This is probably the second widest moat in all of software. I would put it right behind Microsoft, but even Microsoft, it's part of it is just like the super moaty part of Microsoft is all consumer facing software, like your Windows, your Office suite, that type of stuff. The actual B2B side of Microsoft, selling CRM software or various different cybersecurity products and like enterprise solutions, that side of it doesn't have the moat that we kind of think about when we think of Microsoft. And that's the part of the business that most people don't even look at, right? And I think Salesforce CRM, they are the best enterprise software company in the world, and it still has a massive runway of growth ahead of it. I mean, just very brief numbers, very quick numbers, just looking at it. You're looking at a 25 times forward PE, and again, forward PE, take it with a massive grain of salt, but even the cash flow number, right? Like once you adjust out stock-based compensation, you're looking at like, I think 26, 27 times free cash flow. That's around a 4% free cash flow yield, like pure free cash flow yield, excluding stock-based compensation. And out of this business, you're getting a projected 15% growth rate. And in the trailing quarter, they had about a 1% buyback in the quarter that translates to 4% buyback. So free cash flow per share, it's probably going to grow close to 20% for the coming years, right? And you're buying all that at like a 4% free cash flow yield. To give you an idea, Microsoft is trading at a 2% free cash flow yield. So double the valuation, and it's growing slower, right? Imagine that. You're paying twice as much as a premium to get less growth. What hypocritical world do we live in that would ever make sense? And don't give me the moat argument. I would argue they have an equal moat to maybe slightly give the edge to Microsoft, like at least on the consumer side of things. I would definitely give the edge to Microsoft. I think that part of the business is rock solid, but the B2B side of Microsoft isn't as moaty as other companies, other investors think. You know what I mean? So again, like very similar type massive software companies, but one of them is trading at half the valuation. I cannot wrap my head around it. I'm a massive bull on Salesforce. I think it's going to do exceptionally well, and I'm going to be able to say I told you so. Anyways, I digress. Amazon. There's a notion online, and particularly on Twitter, that Andy Jassy is not a good CEO. I would highly disagree. And this notion comes from the fact that, the stock is down from 3-4 years ago, like 2021 until now. And that must mean that, he's not a great CEO, this and that, whatever the case is. I would not say so. Like, I think he's done a remarkable job taking Amazon in at the time that he did with the massive CapEx cycle. And we could pull this up. FinChat thankfully has a lot of KPIs, key performance indicators. We could specifically look at the amount of capital expenditure that this business has done. And so in 2021, when Andy Jassy took over, they were in the midst of the biggest CapEx cycle that Amazon has ever done. You could see that they were spending, in at least 2020, they'd spent $55 billion in that year. And then in 2021, again, when he kind of took over, in that year, they spent $70 billion of capital expenditures. And kind of another way to look at this is to actually look at CapEx to operating cash flow, right? And so this is kind of a percentage way of looking at it. As you could see, at the peak of 2021 and 2022, they were actually investing more into the business business than they were bringing profit into the business. How ridiculous. So they were going into the bank account or taking out debt to reinvest back into the business. That's how big of an opportunity they saw in front of them to be able to invest into the e-commerce fulfillment. And I mean, I think it's worked out wonderfully. I actually recently tweeted about how I put an order in and 11 hours later it was delivered to my house. Just again, like we went from like 2-day shipping to 1-day shipping, same day shipping, and then now it's coming to you within hours. You know what I mean? Like continuously being able to scale and just make the gap between Amazon's fulfillment and Amazon's delivery and the next best competitor is making the gap that much further. I think this was honestly in hindsight, probably a good decision. Of course, going through it was very scary. I personally started investing in Amazon in August or September of 2022. So right in the midst of it, I was invested in the company as it went down to $80 a share, right? Like definitely scary going through it, but in hindsight, I think they made the right decision. I apologize, by the way, this has kind of been all over the place. I'm kind of just talking out at random, but anyways, I guess next in line would be Google, which I mentioned earlier. I did bump it up a little bit. I really like Google. My only problem with it at the moment is in the most recent quarter, YouTube revenues kind of slowed down. I did listen to the earnings call. They mentioned that it's the comparables to the year ago period. It's something to do with that, whatever the case is. It's also a little bit difficult to evaluate. They had a one-time tax thing a couple quarters back. It's kind of making it messy. So I'm not exactly enamored with Google's valuation and financial at the moment, but again, like I just think it is too good of a product, growing way too fast for me to not have it in my portfolio. I think at today's prices, it will outperform the market, and that's why I bought literally yesterday at $160 a share. Moving on, Mastercard. Mastercard is a video I've yet to do a dedicated video on. I guess the buying at all-time highs video I made, that kind of included Mastercard, but like a serious like moat analysis. Let me know in the comment section if you guys would be interested in that video. But I just think of it as like a tax on all commerce, and I'm particularly a fan of the value-added services. That's ultimately where most of the growth of this business is coming from. So again, another way to kind of look at this, down in the segment and KPI section, FinChat actually breaks this out for us. And what we could do is we could click on show percentage change. So again, another very handy feature of FinChat is the fact that it has the segment and KPI section. And if you go down here, you click on the payment network revenue. So it's traditionally the side of the business that like most people know Mastercard for. It's, you know, the payment network. And then there's the value added services. It's a lot of like fraud detection, cybersecurity, a lot of analytics and stuff like that. Like knowing when to, for example, your bank, knowing when to send you a promotional offer. Hey, try out this new high yield savings account. I know, or we know that, you know, you're spending this much money on your credit card. Would you like for us to bump up your credit limit, right? Like you get those promotional emails and all that type of stuff very frequently. That's a lot to do with Mastercard's analytics. It's honestly like a conglomerate of tiny little businesses that they call them tuck-in acquisitions that they bought over time and that type of stuff. So that's that side of the business. And this is the part of the business. If we click on show percentage change here and we simply toggle on the percentage change, you would see, let me put it, yeah, so on the quarterly view here, you would see that in red over here, the value added services side of the business, that is the part of the business which ultimately most of the growth is actually coming from. It's growing just shy of 20%, give or take in like the high teens and whatnot. And then the actual payment network side of things, it kind of ebbs and flows, but I think it'll be able to grow revenues on that side of the business roughly in the 10% ballpark in the very long term. Same goes for Visa, by the way. But the reason why I don't invest in Visa, I prefer to invest in Mastercard, is specifically the value added services. It makes up roughly 40% of total revenues. Again, we could go back down here and toggle it on to kind of demonstrate that. As you can see, it makes up roughly 40% of total revenues. And then on top of that, it is that part of the business is growing at just shy of 20% revenues per year. I think in the next, call it 5 to 7 years or so, that is ultimately what's going to push Mastercard to actually become a bigger market cap business than Visa. To give you an idea, Visa's value-added services segment, which is a little bit shady, I must add, that part of their business is 20% of revenues and growing about the same pace, maybe a little bit slower. But so ultimately, if I were to summarize it, the reason why I'm invested in Mastercard is they have the value-added services, which is growing faster than Visa while making up a bigger percentage of Mastercard's revenues. Ultimately, I think that's what is going to push it over to be able to outperform Visa in the future. Last but not least here, you might have guessed it, ASML, probably one of my favorite businesses ever. I would absolutely love to add more to the ASML position. I think it's a fantastic business. It is a total monopoly on extreme ultraviolet machines. I highly recommend, if you haven't looked into it, there's a bunch of podcasts on Spotify and whatnot investors have done. It's an incredible business. There's a lot of CNBC documentaries. I might link a couple in the description. Fantastic business. It is a choke point in the semiconductor industry. If you've missed out on the AI hype wave and would like exposure to the chip sector, I would say ASML or TSMC is probably one of the best ways to get that exposure and can still benefit off of the secular growth that comes from that sector while not taking too much risk. Of course, chip industry as a whole is extremely cyclical. There's going to be down cycles and your stock's going to get destroyed, but I think these are safer bets in the grand scheme of things. What I personally struggle with ASML isn't the fact that I would have to be buying at a higher price. This has by far been my biggest winner in the portfolio. I bought it at roughly $5.90 a share over here in October, or it must have been late September, I think. Late September or October 2023, I bought it. It's by far one of my best winners, and I'm not afraid of buying at a higher price. Instead, the problem I have is the valuation I'll be able to buy this business at. And with ASML in particular, as you can see, when I bought it in late September, it was at a 28 forward PE. Currently, it trades at roughly a 33 trailing PE. And so I would like for it to get a little bit cheaper before it interests me. I would say roughly in the probably like the high 700s range is when it would be like just shy of a 30 forward PE. I think that would probably start interesting me a little bit more. And by the way, the reason I specifically for ASML never use cash flows is due to the way they run their business. They have a lot of random inventory and working capital stuff that goes on. So the inflows and outflows of cash flow should almost never be followed. It's completely sporadic and random. In summary, I would love to add to ASML. I would like to get it closer to like a 10% position if I ever get a chance to buy it sub $800, give or take. I think that's probably the best I could do. With that being said, I did sign up for this portfolio tracker called Snowball Analytics. I'm not affiliated with them or anything like that. I thought it was pretty cool. My only problem is it doesn't link up with my brokerage properly, so I just kind of gave up on it. But anyways, I was very briefly able to track my performance and whatnot. And this only goes back to my oldest holding, which is Amazon. This doesn't include like literally everything I've ever done. And it particularly doesn't include like all my buys, all my sells. I tried to include the biggest ones and especially all the year-to-date ones, like the Starbucks, the PayPal. PayPal was last year though. So yeah, all the big sales, I've tried to include all that into it. And as you can see, like, I don't know, it kind of just moves with like Amazon, to be honest with you. But currently we're just barely below the S&P 500, just barely trailing it. But as you could see, in late 2023, I was trailing the S&P 500 by like 40%. And since then, we caught up and actually outperformed briefly in earlier this year in like March area, give or take. And then we're just barely under it. Again, I wouldn't put too much weight on this. I think you should probably look at performance like out 3 years, give or take, especially considering a lot of my current holdings that I'm planning on holding, particularly like Salesforce and Mastercard, even Google, like I've only acquired these businesses in the past, call it 6 months, give or take. Like I've had like 60-70% portfolio turnover in the past year, just purely from changing investment strategies and whatnot, right? So again, I wouldn't put too much weight on the performance history in the past or some about even currently. In the future, I think in the next give or take 2-3 years, I'll seriously start to pull ahead, especially as some of the thesis with Amazon, Salesforce, some of these companies starts to pick up. Another metric that I had on Snowball, which I don't have access to anymore, unfortunately, was the IRR, the internal rate of return. I don't understand it fully, but I think it's like the projected, based off the time that you bought your holdings and all that type of stuff, what your performance has been based off the time you bought the different holdings and stuff. Depending on which trades and whatnot I put into it, I was getting between a 16% IRR up to a 19% IRR. I think that means performance, but again, I don't know. I wouldn't be surprised though, like the businesses I own in my portfolio, we could pull it up in the dashboard feature. You could see like they're growing bottom line at like 26%, right? So even if we like assume pretty steep multiple compressions, you're telling me that these businesses that are growing cash flows at 26%, they're not going to have like a mid to high teens growth rate. Add on the fact that on a valuation basis, you're looking at like about market average valuations. Like I think the S&P 500 trades at like 30 times cash flows. Of course, I'm not factoring in SBC here. It would make it drastically worse, but my point still stands. I'm paying up a slight premium to the S&P 500 to own like probably 3 or just shy of 3 times the growth rate. With that being said, that probably wraps it up here. I do want to ask you of one thing. If you stuck around till the end here and you learned anything new, I want you to sign up for FinChat completely for free. You don't need to put any payment information and none of that. Top link in the description. You get 2 weeks of FinChat Pro completely for free. And with that, you get full functionality of the website. And actually, I think next week they're going to come out with a new update, completely refreshed user interface, all that type of stuff. We've been using it all video long. There's a lot of data and charting and KPIs that goes into all the different companies and all that type of stuff. Even before I was affiliated with the website, I was a daily user of FinChat, and you guys could literally go back to videos from months and months ago. I was using FinChat in those videos. So just goes to show, like, I genuinely like the software. Top link in the description, completely for free. You get full access to this for 2 weeks. Thank you for watching and have a great day.